Welcome to Business Day. I'm John Ehrlichman. Let's get back to the market story. Joining us with some perspective is Diana Avigdor. She's the head of trading at Barometer Capital Market, joining us from the TSX. Diana, explain to us this tug of war we're seeing in the stock market right now.
Well, let's start with the life cycle of this short-term trade that's going on. Started in February with yields moving higher in the bond market, selling off, which created a little dislocation in the correlations between the asset classes, that bonds, equities, which does create some reallocation of resources as that happened very fast. That was what we called systematic quantitative program trading. We saw that big sell-off in February, which took us to 200 in moving averages on the S&P, and people deemed it as a good shakeout. It happened very quickly. But what that created is some funds that are selling, that are coming out of the market, and so coming off the highs that we have. We've tempered PEs in a period of good economic growth and good earnings season, of previous, and we're coming up to the next one. So what we're seeing now is we're seeing fund flows which are slightly negative, and we have volatility that has certainly increased. We have a tug of war between these negative headlines, which are coming at a time that the market is a little bit more vulnerable. Let's start with Facebook. That really triggered a bit of a tech selling, as it has been a very crowded trade, lots of money following the tech sector, and Facebook being as high as it has been, and a big weight in tech indices and ETFs certainly created some money flow allocation away from a very crowded trade. This comes in the backdrop, like I said, positive growth economically, earnings season that is great, some good U.S. tax repatriation, tax reform, infrastructure bill that may be coming, and yes, some tariff conversation. So we have this tug between fundamental and granted, the Facebook news was not fundamental in the sense that it's possible that it creates some fundamental issues, but a lot of the asset allocation and flows that have ensued were more programmatic, from the word program, in nature.
Okay, so maybe the robot's playing a role here, because it's one thing to see up and down moves given all the things you talked about. There's lots of moving parts, whether it's trade fears, whether it's what's happening with Facebook, whether it's balancing that out with profitability from companies, as you say, or with tax reforms. There's all these moving parts. A market goes up, a market goes down. But we've talked a lot about on the show already today that in Monday's trading session, the Dow in point terms had its biggest one-day move, its third biggest one-day move ever, and that came after a Thursday and Friday session where you saw the Dow go down 700 plus points and 400 plus points. So why such big swings in the market?
Very big, but you know, John, I will temper that it's not robots, it's people using robots, and there are products out there nowadays that don't concern themselves, and I hate saying this, but it's true, it's not just about return. There's products out there that their product is about volatility and correlation and asset allocation, and those products are not price sensitive. So when a robot executes a program, or a person hits a button to say this program goes out, money needs to be raised in order to meet a certain other metric other than just return, say a volatility parameter or a leverage parameter. That money is not price sensitive, and it does not stop selling, for example, when a price reaches a certain point. Now, there are other things. There is the cross-pollination of stocks, ETFs, indices, all this ETF market and index trading that we see. What happens, for example, Facebook, when it's down, 10%, and it's 5% of the triple Qs, which is the technology ETF, the ETF has to do a lot of heavy lifting to go up when one of its major members are down. So some of these flows are not price sensitive. It's not like me or you, vanilla investors, which will not sell something beyond a certain point. These are big programs, and money needs to be raised, or money needs to be put to work.
Right.
And the tail is much bigger. Now, it comes in the context of less fundamental flows. We've seen before February that the amount of accounts that were opened at the retail level, for example, were very high. So, and most people are very invested. So there's no real heavy hands holding a market. And once you know that this thing can move so much, nobody stands in the way. They just let it play out. So the moves become even more volatile.
So just to go back to your comment about volatility, because when we saw the market correction in the U.S. earlier this year, a lot of people said how you had seen very little volatility. For the longest time, there were no big swings every day. The S&P was just creeping higher every day. So there were people that were betting against volatility, huge amounts of money, and then they got burned in a big way, and that is said to have played a role in that market correction. Now that we are seeing these big moves every day, you're saying that there are people who can make money from that. So they're pleased as punch to see the big up and down days, because it actually can help them make money in a way that a lot of people don't make money, which is you look for a good company and you invest money in it for 2 or 3 years.
I 100% what you said, some of it is very true. I think this is a very great environment, actually. So if the market is something you want to invest in, which based on fundamentals looks like it is, earnings, macroeconomics, economy, so forth, all those things, taxation, policies, if that's all positive and you want to be invested in the market, that's great. What you have short term is you have this volatility, which gives you opportunities. And certainly, from a short-term trading perspective, though, what I would say is just watch those resistance levels, make sure that you wait for those to clear. Because back in January, we didn't have resistance levels. Markets were at highs. But now there is these steps that's kind of holding things back. So we're going to have this volatility. In real terms, I don't think there is risk in the market until the midterm elections. And we are ahead of earnings season. So about 60% of the S&P approximately assessed, speculated, is in a blackout period. So they can't buy back their own shares. And that's a big buyer in the market this year. So it creates some great opportunities, actually.
Okay, lots to watch for. Never a dull moment, Diana.
Sure.
Thanks so much. Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management, with her take on the markets.